The ability to consistently identify institutional manipulation is not a subjective art, but a disciplined science governed by absolute rules. These 20 non-negotiable principles form the bedrock of the Wyckoff methodology, providing a clear map of the Composite Man's actions, whether they are accumulating inventory or distributing holdings. We are committed today to delivering the definitive framework, ensuring you possess the exact criteria needed to differentiate genuine market shifts from engineered traps designed to shake out the uninformed masses. Mastering this structure allows a trader to stop reacting to noise and start aligning their positions with the market's most powerful participants. We will systematically divide these 20 rules into 3 critical categories: the immutable foundational laws, the specific criteria for accumulation mastery, and the crucial signals for distribution mastery. This structured approach ensures that you not only recognize the patterns but understand the underlying forces of supply and demand, driving them at every stage. Before we dive into the technical depth of these rules, which are essential for your trading survival, please take a moment to engage with the community. Before we continue, please take a moment to subscribe and leave a quick comment, even just a single word, to confirm the value of this deep technical analysis. This simple action greatly helps the algorithm recommend this video to more people who need this precise knowledge, and shows me that this kind of content truly matters and is worth creating for the advanced trader. And please never forget to return to the channel during those challenging times, especially when trading becomes difficult and your confidence starts to waver in the face of market uncertainty, as we are here to reinforce your discipline. The 5 foundational rules are the immutable laws that dictate how all price and volume action must be interpreted within the larger Wyckoff framework, setting the stage for tactical analysis. These laws provide the necessary context, ensuring that the observation of a specific event, like a spring or an upthrust, is correctly situated within the larger market cycle. Without adherence to these foundational principles, even the most textbook patterns can lead to catastrophic misinterpretations and poorly timed entries. They function as the philosophical and mechanical filter through which all subsequent technical rules must pass before a trade is initiated. The first and most critical rule demands that the trader constantly assess whether demand is definitively overwhelming supply, leading to rising prices, or if supply is overwhelming demand, resulting in falling prices. This assessment is not based on wishful thinking or emotion, but on the objective relationship between the price spread and the corresponding volume supporting that movement. A strong uptrend must be consistently characterized by wide price spreads on high volume during rallies, contrasted with narrow spreads on low volume during reactions, confirming the dominance of institutional buying pressure. Conversely, a bearish environment is confirmed when selling waves exhibit wide price action and heavy volume, while subsequent attempts by buyers fail to generate significant interest or upward momentum. The law of supply and demand is the ultimate arbiter of the market's immediate direction, overriding all secondary technical indicators that might offer conflicting signals. Never initiate a trading position unless the underlying horizontal structure, recognized as either accumulation or distribution, is sufficiently developed to justify the anticipated vertical movement, which is the effect. The cause is meticulously measured using point and figure charting methods, which quantify the energy stored within the trading range based on the number of columns built during the horizontal consolidation. This quantified cause must then be translated into a specific measurable price target, representing the projected vertical effect that the market is likely to achieve upon breakout. If the calculated cause only projects a minimal upward move, the risk of entering the trade is usually disproportionately high compared to the potential reward, violating the fundamental tenets of prudent risk management. Therefore, the Wyckoff trader must patiently wait for the Composite Man to build a robust horizontal structure before attempting to capitalize on the powerful vertical move that inevitably follows. Demand confirmation requires complete harmony, meaning that high volume, which represents the significant effort expended by traders, must concurrently produce a significant price movement, which is the quantifiable result. When high effort fails to generate a proportional result, this discord immediately signals impending reversal, or confirms the ongoing absorption of supply by large professional interests, For example, if a major rally occurs on massive volume but only manages to push the price slightly higher, this suggests that institutional sellers are meeting the demand, preventing the price from advancing further despite the enormous buying pressure. Recognizing this fundamental disharmony between effort and result is crucial for identifying early warnings that the current trend is exhausting itself or that a major reversal campaign is currently underway. The disciplined trader must adopt the unwavering assumption that all major sideways ranges observed in the market are carefully engineered campaigns orchestrated by sophisticated institutional entities, known collectively as the Composite Man. This rule demands that the trader align their positions exclusively with the inferred direction of this powerful institutional entity, rather than fighting against the flow of smart money. Since the Composite Man controls the liquidity and the manipulative processes necessary to build cause, attempting to trade against their campaign is inherently speculative and often leads to significant losses. Successful Wyckoff trading is fundamentally about identifying when the Composite Man has finished their campaign, whether accumulation or distribution, and then entering the market precisely at the point of confirmed institutional commitment to the new trend direction. Always use the three-dimensional analysis framework, which includes assessing the position in the trend, the structural integrity of the current trading range, and the immediate price action, to ensure the current observed activity aligns with the direction of the dominant market cycle. The current trading range, whether accumulation or distribution, must be contextualized within the preceding larger movement, determining if it is a primary reversal structure or merely a reaccumulation within an ongoing uptrend. If the immediate price action, such as a strong sign of strength, contradicts the established structure of the trading range or the position within the larger trend, that signal must be treated with extreme skepticism. True mastery involves integrating these three dimensions into a coherent narrative, ensuring that the tactical entry aligns perfectly with the strategic direction of the entire market. Accumulation is the highly structured process where the Composite Man systematically absorbs supply from weak retail holders, preparing the groundwork for a substantial markup phase. These 8 rules provide the specific technical criteria required to accurately navigate the 4 distinct phases of the accumulation schematic, ensuring that entries are timed precisely as institutional commitment confirms. Failure to adhere to these detailed guidelines often results in prematurely buying into selling pressure or being shaken out during the intentional market volatility designed to trap the impatient trader. By meticulously verifying each of these rules, the trader gains the confidence to hold through the inevitable volatility of the consolidation period. The initiation of the accumulation phase must always be marked by a dramatic selling climax, which is characterized by ultra-high volume and a significantly wide price spread, demonstrating a panic selling event. This climactic action represents the final exhaustive dumping of inventory by retail traders who can no longer tolerate the falling prices. Immediately following this climactic low, the establishment of the automatic rally boundary is crucial, as this high point defines the upper resistance of the initial trading range. The volume on the selling climax must stand out dramatically when compared to the preceding downward leg, acting as a clear, visible signature of the institutional absorption that arrested the decline. Initial tests of the previous selling climax low, known as the secondary test, must exhibit significantly reduced volume compared to the original climactic action, serving as the first confirmation of supply exhaustion. If the secondary test returns to the climactic low on heavy volume, it indicates that institutional absorption is incomplete, and further declines are highly probable before the cause can be fully built. The successful test confirms that the majority of floating supply has been absorbed by the Composite Man, meaning that sellers are no longer willing to part with their shares at those lower prices. This low-volume retest is a critical prerequisite before the market can confidently transition into the sustained price oscillation of Phase B. Look for extended periods of price oscillation within the trading range where high volume consistently fails to create new lows, which is the primary confirmation of ongoing absorption of floating supply. During Phase B, the market will attempt to revisit the support area multiple times, but each attempt must show less downward momentum and diminishing selling pressure. The high volume days that occur must be analyzed closely. If high volume is present but the resulting price movement is confined and does not break support, it signals that the Composite Man is actively buying into every selling wave. This persistent failure to break support, despite recurring efforts by sellers, is the mechanical evidence that the cause is being built effectively and methodically. Volume must shrink dramatically on the decline toward the established support line during the later stages of Phase B, definitively indicating that selling pressure is drying up before the final intentional shakeout. This pattern of shrinking volume on dips confirms that the large professional investors have already accumulated the bulk of the available supply and that only minimal selling interest remains in the market. A successful flatline test gives the Composite Man the confidence to proceed with the spring or shakeout action, knowing that the structural integrity of the range is secure and the risk of a sustained breakdown is low. If volume remains heavy on subsequent declines in Phase B, the trader must assume that the accumulation process is still incomplete, demanding continued patience and caution. A true and effective spring action must fulfill two simultaneous requirements. It must penetrate convincingly below the established support of the trading range, and it must immediately close back inside the range on strong, confirming demand. The penetration below support is essential because it triggers stop-loss orders from retail traders who bought within the range and traps late sellers who initiate short positions based on the perceived breakdown. The immediate reversal and strong close back above the support line, often accompanied by a spike in volume, provides the unmistakable signature of the Composite Man's decisive action to seize the last available supply. Without the swift reversal and a strong close back into the range, the penetration is simply a genuine breakdown, indicating that the market is still in a markdown phase. The most reliable and highest probability entry confirmation occurs when the price returns to test the level of the spring, or the secondary test low, and executes this retest on extremely low volume. This crucial low-volume retest confirms that the spring successfully cleared the market of remaining supply, and that there are no remaining sellers willing to challenge the Composite Man at this critical support level. A high-volume retest of the spring level would suggest that the initial shakeout was ineffective, and that another downward attempt is likely, thus invalidating the immediate bullish setup. The low-volume retest provides the ideal low-risk entry point, placing the protective stop just below the spring low, maximizing the potential reward-to-risk ratio. The definitive breakout from the established trading range, known as the sign of strength, must be accompanied by the highest volume seen since the original selling climax, unequivocally confirming institutional commitment to the markup. A breakout that occurs on low or average volume is highly suspicious and often suggests a false move, lacking the necessary institutional fuel to sustain the vertical advance. The sign of strength is the first clear evidence that the cause built during phases A, B, and C is now translating into the effect, marking the transition from the horizontal structure to the vertical movement. The strength of the initial breakout volume provides a vital measure of the institutional conviction behind the move, which is essential for projecting the durability of the subsequent uptrend. The subsequent pullback that inevitably follows the sign of strength, designated as the last point of support, must absolutely hold above the former resistance line of the trading range, and it must exhibit a sharp reduction in selling volume. This successful test of the broken resistance, which now serves as support, confirms the structural integrity of the breakout and establishes a new, higher support level for the market. If the price penetrates back into the trading range during this pullback, the sign of strength is invalidated, and the market likely requires further accumulation or is preparing for a new shakeout attempt. The last point of support provides the final high-confidence opportunity for traders who missed the spring entry to join the newly confirmed uptrend with a tight, well-defined stop-loss. Distribution is the complex process where the Composite Man systematically unloads their accumulated inventory into the market demand, preparing the ground for a devastating markdown phase. These 7 rules focus specifically on identifying the weakening demand and increasing supply that characterizes this top formation, ensuring the trader liquidates long positions or initiates short trades at optimal moments. Recognizing distribution early is paramount. as the markdown phase often progresses much faster and more violently than the preceding markup. By focusing on the divergence between effort and result, and the failure of demand to sustain rallies, the trader can avoid the catastrophic losses associated with holding assets as the institutional selling begins. The distribution process begins with the identification of the buying climax, which must be clearly marked by massive volume exhaustion spikes at the peak of the preceding uptrend, immediately followed by the establishment of the automatic reaction low. The buying climax signifies the final, frantic buying by retail investors, often driven by euphoria and speculative media attention, into which the composite man is systematically feeding their inventory. The volume on this climax must be extraordinary, demonstrating the intense institutional supply necessary to halt the powerful preceding rally. The automatic reaction defines the initial lower boundary of the distribution trading range, establishing the critical range that will contain the subsequent price action. The second rule of Phase A requires the trader to precisely define the preliminary supply and the definitive buying climax boundaries, as these points establish the horizontal resistance line that the composite man must defend throughout the distribution process. This resistance line represents the price level where institutional sellers are most aggressively unloading their holdings, preventing the price from advancing further despite repeated attempts by buyers. The structural definition of the initial range is crucial because all subsequent rallies, including the secondary tests and the final upthrust, will be measured against this established resistance. Understanding this defended boundary highlights the institutional commitment to capping the price and preparing for the inevitable markdown. Within the oscillation of Phase B, demand must consistently fail to create higher highs on subsequent rallies, unequivocally demonstrating that the composite man is maintaining control by supplying the market at the upper bounds of the range. Each rally that falls short of the buying climax high signals that the institutional supply is overwhelming the available demand, slowly weakening the market's underlying structure. This failure of demand provides mechanical evidence that the cause for the markdown is being meticulously built, as the composite man uses these rallies to offload massive quantities of stock without crashing the price prematurely. The trader must view any rally that fails to surpass the previous high as a confirmation of underlying weakness, signaling that the supply is gaining dominance. Look specifically for rallies during Phase B that show decreasing volume compared to the massive volume seen during the initial buying climax and the previous Phase A rallies, signaling that new committed buyers are becoming scarce. This volume divergence indicates that the institutional sellers do not need to exert as much effort to halt the upward movements, because there is insufficient natural demand remaining in the market. The persistent decline in volume on subsequent rallies confirms the erosion of genuine buying interest, suggesting that the composite man is successfully distributing their holdings without attracting significant new participation. Recognizing this volume shrinkage on up moves is a major red flag, confirming the structural integrity of the distribution schematic. The critical shakeout action in distribution is the upthrust action, which temporarily pushes the price decisively above the established resistance line of the trading range, specifically to trap retail breakout buyers. This maneuver is designed to convince late-stage speculators that the uptrend is resuming, forcing them to establish long positions at the highest possible prices, providing the composite man with the final liquidity needed to complete their distribution. The most telling characteristic of a true upthrust is its immediate and violent reversal. The price must quickly fall back into the trading range, leaving the newly initiated breakout buyers trapped in losing positions. This aggressive reversal confirms the final institutional commitment to the markdown, signaling that the distribution is complete and the market is ready for the decline. The decisive break below the trading range support, known as the sign of weakness, must be immediate and occur on extremely heavy volume, confirming that supply is now unequivocally dominant and overwhelming any remaining demand. This high-volume break is the mechanical signature of the composite man aggressively selling into the market, pushing the price below the established floor of the distribution structure. A break that occurs on low volume is often treated as suspect, potentially signaling a failed test or a minor shakeout, but the heavy volume confirms the institutional participation necessary for a sustained markdown. The sign of weakness transitions the market from the horizontal structure of cause to the vertical movement of effect, initiating the official markdown phase E. The rally back to the broken trading range support, which now functions as resistance, is termed the last point of supply, and this rally must fail to penetrate the resistance line while occurring on very weak, shrinking volume. This low-volume failure confirms the market's inability to return to the higher price levels, signaling that demand is exhausted and that the broken support has definitively transitioned into a formidable ceiling of supply. If the price manages to penetrate back above this broken support line, the sign of weakness is potentially invalidated, suggesting the distribution was not yet complete or was a failed attempt. The last point of supply offers the final, high-probability entry for short sellers, providing a clear, defined stop-loss just above the newly confirmed resistance level. These 20 rules provide the comprehensive framework necessary to transition from speculative guessing to methodical, rules-based trading, entirely aligned with the movements of smart money. We have covered the critical laws governing market dynamics, the 8 specific criteria required for successful identification of accumulation structures, and the 7 definitive signals that confirm a major distribution top. Mastery is achieved not through the isolated observation of single events, such as recognizing a spring, but through the systematic application of all 20 rules in concert, ensuring every element of the schematic is verified before commitment. This integrated approach ensures that the cause is robust, the volume confirms the institutional intent, and the specific entry point is timed perfectly within Phase D. The diligent trader recognizes that the market is a continuous loop of cause and effect, and the successful application of these rules allows for the precise measurement and anticipation of the next major move. True confidence in the market is born from this rigorous adherence to the Wyckoff structure, replacing emotional decisions with quantifiable evidence of institutional campaigns. Your commitment to mastering these 20 rules is the single greatest investment you can make in your trading career, providing the necessary discipline to navigate the manipulative landscapes of modern finance. Understanding the complexity of institutional campaigns requires not just observing the market, but deeply internalizing the foundational principles established by the great market pioneers. If you found this detailed breakdown valuable and are seeking to deepen your understanding of how large operators think and execute their strategies, we strongly recommend turning to the source material. We have an adapted edition of Richard Wyckoff's classic work, How I Trade and Invest in Stocks and Bonds, which serves as the perfect companion to this lesson on accumulation and distribution. This essential book reveals Richard Wyckoff's time-tested methods for analyzing the market, precisely determining the intentions of the large players, and making the robust, informed trading decisions that lead to consistent profitability. It provides the historical context and the practical application examples necessary to elevate your understanding beyond theory and into actionable market mastery. You can find the link to this foundational text and start your journey toward true market expertise in the description below, allowing you to build your trading house on the solid rock of proven methodology. The journey to trading mastery is continuous, demanding constant review and rigorous self-assessment against these 20 established rules. Never deviate from the structural discipline, and always remember that patience is the ultimate weapon against the Composite Man's manipulative tactics. The market will always reward those who wait for the high-probability setup confirmed by the full weight of the Wyckoff methodology, providing ample opportunity for profitable engagement.